Hi, this is Sean Hyman from MyWealth.com, and I want to talk to you today about the dollar's recent rally and why I call it a sucker rally, or a rally that's within a bear market. Let's go ahead and get started and I'll show you why.
Be sure to check out the written blog at www.mywealth.com/blog. I want to talk to you today about don't be fooled by the sucker rally in the dollar. Now, why do I say this? Because the fundamentals that produce the trends have not changed. Let's take a look at the fundamentals on the next slide so we can see where the money is likely to flow. And here we see year-over-year CPI as a consumer price index. It's inflation at the consumer level, which is what the central bankers watch the most. And it's on a year-over-year basis. Watch that because the numbers don't fluctuate so drastically as they do on a month-over-month basis. And what can we see? We see the high inflation at the top of the list and the low inflation, actually deflation, at the bottom of the list. And so you've got New Zealand and the UK and Australia being the top three that are carriers of inflation right now. 1.9% for New Zealand, 1.8% for UK, and 1.5% for Australia. And New Zealand and Australia happen to have the highest interest rates of all the industrialized nations, coming in at 3% for Australia and 2.5% for New Zealand. The UK has been down at 0.5% or half of 1%, and has been their central bank's been continuing to print money. So it's probably not the ideal candidate of these top three like the other two are, New Zealand and Australia. And then what do we have at the bottom of the list? We have negative inflation, which is deflation. So Japan, negative 1.8%. The United States, negative 1.4%. So, why do central banks raise interest rates? They raise interest rates to fight inflation. Well, if there's no inflation to fight, then you're certainly not going to raise interest rates. So, therefore, even before the Fed meeting, even before the Fed meets, we know from this that the Fed is not going to raise interest rates now, and they're not going to do it probably in the next meeting or two or so, because we got to get out of deflationary mode back into inflationary mode in this country before the U.S. Fed can raise interest rates. Money follows rates. Money seeks yield. Investors want to seek the highest yields on their money, so therefore they're going to go to where the inflation is. They're going to go to where the rates are high and to where the rates are going higher. And why are they going to be going higher? Because of inflation growing. So the places that are likely to have interest rates rise the soonest are places like Australia and New Zealand, and therefore you're probably going to see the money continue to flow to those places, even as it already has overall. Now, does this mean every day it does that? No. There are pullbacks within uptrends, just like there's this what I call a bear market sucker rally in the dollar right now within its downtrend. Now, the technical picture really complements the fundamental picture, and it should, because it's the fundamentals that produce the technical trends anyway. So let's check out the U.S. dollar index chart on the next slide. And what do we have here? We got the daily chart going back a year on the dollar index. That's the dollar against a basket of currency. So it's a broad look at the dollar, and that's why I like to look at it that way. Because if you can see what the dollar's doing, then you know what it's going to be doing against most pairs out there. And so we see there's a huge downtrend in the dollar, and it's been that way ever since March. Fundamentals of countries don't change trends very frequently, and so neither do their technical trends on the charts, because remember, fundamentals and the motion that's set in place there produce the technical trends on the charts. So therefore the technical trends don't change that quickly either. And so we can see the red downtrend line showing our downtrend, which again complements the fundamental picture. We can see there's a 50-period simple moving average, which is the line above the latest price action, and the price trades down below it. Now, could the dollar rise a little further? Sure, it could. Could it rise another 50 or 100 pips or more? Absolutely. But let's look at the other technical indications, and you can see slow stochastics is almost back to overbought levels and about ready to hook over and head down again in this downtrend. You've got the MACD with its lines trading below the zero line on the MACD in the red circled area, and that acts like a weight on the price action as well, because when the price is above the zero line, the pair tends to have more of a tendency to trade upward, and when it falls below the zero line, the pair has a tendency to be in a downtrend and trade downward. It's almost like ankle weights being upon the pair. And so the dollar is down. The dollar is likely to stay down. The fundamentals have not changed. The fundamentals are likely to go to where the inflation is and away from where the lack of inflation is or where the deflation is. It will rally up sometimes in a bear market, just like an uptrend and a bull market has pullbacks. And that's normal, and those are always expected. For some reason, traders are shocked almost when there's a rally within a bear market. It doesn't mean a trend change, but it does mean that there is a correction of excesses, a correction of overshoot to the downside in the short term before the downside continues. Therefore, we should buy the inflationary currencies and short the deflationary currencies. This is the big, broad picture. It doesn't mean like today, this exact second, this exact moment, but that should be in the back of your mind. And then so you should be looking for technical entries, technical buy signals into the Australian dollar, the Australian against the Japanese yen, the New Zealand against the US dollar, and the New Zealand against the Japanese yen, because these are the inflation versus deflation plays. Again, do your own analysis, see if it agrees with mine. If it does, then you can place trades. If it does not, it's okay, pass on it. Every trader does not agree. Here is where you can get a hold of us at mywealth.com. You can go to the Active Traders page and click on Currency Trading Course, and you can click on this short video to find out more about our currency courses, to find out really how to get an in-depth education to really learn what makes this market tick. Everybody needs to do that, because you are trading against experienced traders who want to be the winners and you be the loser. In other words, you be the one that basically hands your money over to them, and they are the educated ones. And aren't the educated ones the best that do the best in any venue of life, any profession, any hobby, any sport, anything? Those that are the most practiced, the most skilled, the most educated do the best. And so that's why I highly encourage you to take the currency trading course. It'll be well worth your while. But also on that page, you can click on the chat button that I've got circled there to talk more. Talk to us more, find out more about the courses. You can call us at 1-866-255-9677. That's 1-866-255-9677. Or you can just click and view that video. Again, if you've got all the information you need, or once you've done that, you can click on the Enroll Now button and get enrolled in a course. I would highly encourage that. But don't wait. Whatever you do, get in a course, get educated today at www.mywealth.com.
I hope you enjoyed that today. A lot of people think that inflation is just everywhere and it's rampant in the world. Sometimes it is. But as you can see right now, it's very spotty in the world. It's definitely not in the U.S. It's definitely not in Japan, some other places. It definitely is in the U.K. It definitely is in New Zealand. Definitely is in Australia. So you got to run to where the inflation is. And as we talked about, New Zealand and Australia are the picks over the UK right now, and the US and Japan is definitely the place to run away from. So that's where the money is flowing flowing from and to. And so that's where you got to go, is where the inflation is. That's where the fertile ground is. And so I'd encourage you to get in one of our courses today to learn more about all this and more about the dynamics of where money flows to and why. And so I'd just encourage you to get started in that today at mywealth.com. Thanks so much for attending. Bye-bye.